All right. Let me start by saying good afternoon to you all. Where I am in Johannesburg, it's afternoon, but also good morning. You might be somewhere else where it's in the morning, and good evening as well, because you might be somewhere else where it's in the evening. Welcome to our series on webinars that we have been holding as the IAA Banking Virtual Forum. I'm joined here by Meet Pandla and Nancy Kelly from the IAA, the team that is assisting us with holding this webinar. And today the webinar is on market risk management. And our speakers, we've got Lawrence Hababe, who is a very senior actuarial professional in banking, across various different areas of risk management in banking, and especially market risk. You also have got Ian Allen. Ian Allen is a very senior banking actuary, having worked for banks such as RBS for, I think, probably about 35 years or more, actually. And most of you would already have met Ian. He has been at previous webinars. You also would have met Lawrence. He has been at previous webinars. And myself, Michael Tichareva, I'm the chair of the IAA Banking Virtual Forum. We have got 1 hour for this webinar. So I would like to hand over to Ian and Lawrence. But before I do that, Nancy will take us through some housekeeping rules, and then we go straight into it. Enjoy the webinar. Thank you.
Hi, everyone. Just a few comments on housekeeping items before we begin. This will be a very detailed presentation. So as we go along, if you have questions, we ask that you submit them in the Q&A using the icon at the bottom in the middle. Please note that this session is being recorded, and a copy of the recording and the presentation will be available on the IAA website within the next day or so. A short disclaimer, please note that anything stated is a viewer and opinion of the presenters, and it is not to be reflected on the IAA as a whole. Thank you, and enjoy the presentation.
Right, Lawrence, next slide, please. So the Basel regulations of banking were introduced in 1988. At that time, actually, I was working for the Swiss bank UBS. Initially, the Basel regulations applied only to credit risk. As shown in this route map, market risk was added in 1996, with additions and amendments in 1997 and 2005. But as you all know, the regulations were not effective in preventing the banking crisis of 2008, a horrible period in my memory. But since then, a lot of work has been done in market risk to add and amend the regulations, leading to important papers in 2016 and 2019. And having lived through all this period, I would say that these amendments and additions have addressed the shortcomings which became apparent in 2008. Of course, we never know what new problems might lie ahead. If any of you are interested in the evolution of regulations, working for a bank, other people have lived through all this, that summary paper mentioned at the bottom is very useful. It's only 5 pages. Next slide. You need to go through the history, because with all this work on the regulations, they've been incorporated in an omnibus edition, the Basel Framework, but it does run to 2,000 pages. This is the market risk section. Even that goes on for about 200 pages. So for Lawrence to cover market risk in the next webinar, quite a lot of stuff to get through. What are the main things we want to look at? before loan starts. As shown on this page, we want to understand the assets that are subject to market risk and which of them have to be in the bank's trading book rather than its banking book. For measuring risk, we need to know about the standardized approach and the internal models approach. Not on this slide, we need to know from launch experience about the management of market risk, and from both our experience about how actuaries can contribute in banking in market risk. Right, Lawrence, off you go. Thank you.
Ian, and thank you, Michael, for the introduction. Okay, today's presentation would be focusing on market risk management. This is an introduction. Some of the components of this presentation will feed directly into the second presentation, and that is going to be more focused on the Basel III fundamental review of the trading book, which is the methodology to compute the market risk-weighted assets on banks' balance sheet, particularly for all trading books that fall within the regulatory requirements. In today's presentation, we'll start by talking about the different and the various risks that are faced by financial institutions, in this case, banks, but of course it applies to other institutions. We'll zoom in on a definition of market risk per the regulatory text. What are the sources of market risk? What are the risk classes that are defined in the Basel III FRTB regulatory text regarding the different risk classes? Then I will talk a little bit about the desk. What is a trading desk and why is a trading desk important? In this particular area, I'd like to focus on the different type of products that are traded by the different desks, because these products are the instruments that are inside the portfolios that they need to be basically evaluated to compute the market risk for. Then I will talk about the concept of the trading book and the banking book. What is a trading book? What is a non-trading book? What are the requirements, regulatory requirements to classify an instrument as a trading book instrument? And talk a little bit about the Basel III FRTB boundary. What have the evolution of the boundary and why is it important? Then we will move into risk measurement, risk appetite, and risk limits, talk about the different models that are used under the Basel III FRTB to quantify market risk exposure in all trading book across the whole trading book. We'll talk about the internal models, and we will talk about the sensitivity-based approach. Then we'll talk about market risk management, the three lines of defense, the risk governance structure, the risk appetite, the policy framework, and the rigorous processes and controls that needs to be placed. Of course, some of these components will only touch not very deeply because of time, but they are important to know because, as I said, they feed directly into the FRTB regulation. Then Ian and I will talk about the actuarial skills and their role in market risk management. Just a quick one regarding the second presentation. We will basically, in the second presentation in November, we will zoom into the fundamental review of the trading book. We'll review the evolution of the regulatory regime, what happened between Basel 2.5 and Basel III, why the regulator introduced further regulation. We dig deeper into the boundary, the standardized approach for computing market risk capital charge. We'll look at the different components of the internal model-based approach. We'll look at the counterparty credit risk framework and the CVA evaluation and the public disclosure. And we will end with an example to compute the risk-weighted assets for market risk for a portfolio that has exposure to general interest rate risk in its book. So let's see, financial risk. So financial institutions in their day-to-day operations, they face a number of risks. So they face counterparty credit risks, operational risks. To give you some definitions, the counterparty credit risk, and this is important because during the 2008 global financial crisis, a lot of the losses that occurred on banks' balance sheet occurred from basically underlying instrument that defaulted. and these instruments were mainly in the trading book. So the regulator introduced the concept of a counterparty credit risk, and this is the risk that arises due to the default or rating migration of an underlying obligor. When an underlying obligor, let's say, for example, a sovereign or a corporate or a municipality that issues a bond and it defaults, stops payment, or maybe if basically you buy the bond with the intent to trade, you buy it high and then the price sort of falls, you make a mark-to-market loss. So they introduced these sort of framework to compute the counterparty credit risk on all balance sheet exposures. They are also faced with market risks and operational risks, and these are the risks that arise on a bank's balance sheet due to failed internal processes and procedures and fraud. Operational risk also includes other aspects of risk. So, for example, what we call some externalities, for example, the COVID pandemic or geopolitical wars. These sort of emerging risks, they do have, and climate change, they do have an impact on the financial side of the economy, impacting capital flows and ultimately impacting the risk factors, the FX and the commodity prices that feeds into the valuation model for market risk. And they are also facing funding and liquidity risk. Liquidity risk basically is the risk that if you have an instrument, you cannot sell it at a market price, and that causes you losses. Of course, under the Basel III FRTB regulation, particularly for the internal models approach, which is basically a method to compute the market risk capital charge, one component is the liquidity assessment of all risk factors that needs to feed into the risk and capital models, which means that these risk factors, they have to be liquid based on some prescriptive regulatory requirements and measures of liquidity. We'll come to this later. And of course, credit risk in the banking book. And now the credit risk, you will have two types of credit risk: credit risks that arise in the banking book and credit risks that arise in the trading book. The credit risk that arise in the banking book can arise from the loans that banks issue, for example, to customers, mortgages, car loans, credit card loans. So pretty much this is the various risks that are faced by a financial institution in its day-to-day operations. The regulator defines market risk as the potential loss, okay, on all trading book positions. And we're talking about what kind of positions? We're talking about all positions that are held in a portfolio, okay, under a desk or the whole trading desk with the main intent to trade, meaning that you buy these assets at a low price and you intend to sell them at a higher price, or any sort of trade that are part of client facilitation. And, for example, a client wants to hedge some interest rate on a bond that's paying fixed coupon. He wants to hedge it. He enters into a swap where the counterparty becomes the bank. So the market risk is the losses that arise from fluctuations in market risk factors. And these market risk factors, they feed into the valuation models that computes the value of all positions and generates the P&L. The regulator defines the Basel III regulation FRTB text defines five broad risk classes. So it defines general interest rate risk, which is basically the risk that arises from movement on all types of interest rate curves. So for example, if you take the euro currency, in any bank, they will have different types of interest rate curves. An interest rate curve basically is a depiction of the rate of return, okay, the interest rate over a given period. So they will have, for example, an overnight index swap curve. They will have like a discount curve to discount future cash flows. They will have a future or what you call a forward projecting curve, curve that projects forward interest rates with different tenors. Could be 3 months, could be 6 months, could be 9 months. So of course, you have to take into account different currencies. Could be dollar, could be euro. So each currency will have a number of curves that are used for different types of products. They also defined foreign exchange risk, and this is the risk that arises from movement in foreign exchange currencies. Could be spot, for example, Euro USD or Jordanian dinar GBP, or Canadian dollar US dollar. So anything that has an underlying FX rate or an FX implied volatility driving the value of, let's say, an FX derivative, falls under the FX risk class. Then we will have equity prices, and these are the prices of Equities could be from any sector, could be any index, could be any country, for example, the US S&P 500 index, or it could be the Amman Stock Exchange, or it could be the Euro Stoxx 100. So it's basically any equity, whether individual equities or indices, fall under the equity risk factor class. And then you have commodity prices, covering a range of commodity prices from oil, grains, agricultural, dairy. So anything that falls under the commodity anything related to commodity falls under the commodity risk class. And then you have credit spread risk. Credit spread risk, the regulator breaks down the exposure into different types of risk classes. So first you have securitization products, then you have securitization non-correlation trading portfolios, and you have securitization correlation trading portfolios. And these sort of the differences between them, is that in securitization assets, basically, these are portfolios of asset-backed securities that have underlyings, for example, could be fixed income bonds, could be sovereign or corporate or municipality, or it could be other types of receivables. So these are the 5 broad risk classes that are basically stipulated in the Basel III FRTB regulatory text. And as I said, these are the risk classes, and under each risk class there are a number of risk factors, and these risk factors are the variables that drive the valuation of the instruments in the portfolio and the whole portfolio. If you work in market risk management, it is very important to basically have an excellent familiarity with the different type of financial instruments that are traded by banks. Yeah. And these financial instruments could range from spot instruments and derivative instruments. So spot instruments, as we sort of mentioned before, could be just vanilla bonds, and could be equities or foreign exchange or commodities, or even future and forward on the underlying, which is a bond or an equity or an exchange, foreign exchange currency. And then you have those derivative instruments. Basically, some of these derivative instruments are used to hedge a trading position exposure, and some of them basically are used to facilitate client needs. A client wants to hedge, for example, an FX rate, or he wants to hedge an interest rate, or he wants to hedge a fixed cash flow or a floating cash flow. So they enter into these derivative instruments. And these derivative instruments, they range. For example, interest rate derivatives, you have linear and nonlinear interest rate derivatives. The foreign exchange, you have linear and nonlinear. Commodities and equities and fixed income, you also have options on these. And it's important to be familiar with the different types of products. For example, interest rates, what is a swap? A vanilla swap that pays, for example, a fixed coupon annually, and on the floating leg, it pays a quarterly coupon with a maturity of 5 years. So from a market risk management perspective, you need to be familiar how to value this product from first principles, meaning you need to be able to construct the curve using liquid market instrument. The curves, for example, we're talking about range from overnight to 60-year tenors, right? You need to bootstrap the curve. You need to bootstrap the discount curve. You need to bootstrap the forward projecting curve to project forward the 3-month LIBOR over different tenors up to and including the maturity of the underlying swap. And then you need to basically do some use some mathematical techniques to get the swap rate and price the product. So you need to be familiar with the different instruments that are traded, how they are being valued, and more importantly, the underlying risk factors that drive the value of these derivatives. And these risk factors, this is not sort of pretty much, it includes most of the risk factors that are used in the valuation and risk management of different market risk exposures. These particular risk factors are not only used to market your daily products in your trading portfolio, but they are also used to calibrate your models. So if you don't have a liquid market price for a particular product, you need a model to model the price and to get a valuation. So the model that you choose with the underlying assumptions will have to be calibrated, for example, to the spot rate, or it has to be calibrated to the diagonals in a swaption, interest rate swaption at the money volatilities. So from a market risk management, you must be familiar with the different types of risk factors that go into risk and valuation models. The other important point here is having a familiarity with those risk factors will give you, basically will tell you if the risk factor is going to be included in the standardized based approach, or it's going to have to be part of, I mean, the market risk charge is going to be part of the residual risk add-on. So being familiar with those risk factors, how they are constructed, the dynamics, meaning how do they react in the market to news, wars, or, for example, climate change events, or any emerging risk, how the surfaces basically behave, how the surface moves is important. And we'll get to the linkages between those different risk factors and the Greeks, or the valuation sensitivities that feed directly into the standardized based approach for computing market risk capital under the fundamental review of the trading book. Okay, so what is the concept of a trading book and a non-trading book? Before we dig into this a little bit, let me give you, let's talk a little bit about the structure of the French office. So if you work in a bank, risk management or market risk management will engage directly with the French office. The French office is basically where all the traders trade their products. So you have different desks, yeah? The Basel III fundamental review of the trading book has the concept of the desk is very important. As I said, a desk is basically a bunch of traders trading in different markets. They could be trading in linear interest rate derivatives. They could be trading in fixed income corporate bonds. They could be trading in fixed income sovereign bonds. They could be trading in foreign exchange markets. They could be trading in commodities markets. They could be trading in the equity market, could be spot products or derivatives. So the FRTB regulation requires that everything needs to be approved at the desk level. So you have the desk, you have the traders, they trade different currencies, different markets within the same risk class, and you have hundreds of portfolios, and the portfolios will have hundreds and tens of thousands of trades. So basically, when you compute your FRTB regulation, you need to have first approval to include those trading desks in your model, whether it's the standardized based approach or the internal model. And based on that, you need to compute basically your minimum capital requirement, your public disclosure, and your minimum capital requirement, your public disclosure, the requirements to disclose your risk-weighted assets on the desk level, and your supervisory review process. To label an instrument or a trade as a trading book asset versus a non-trading book asset, we have to understand what it means to hold an asset to maturity, or to hold it for trading or available for sale. So under the IFRS sort of definitions, an asset that is held to maturity, yeah, mean that you hold this particular asset. I buy it today. Let's say I buy the Jordanian government issued government bond today. It was issued today. It has a maturity of 5 years. Now, if I'm only interested in collecting the coupons and the principal at maturity, then I hold it to maturity. That means, from a risk perspective, market risk perspective, it goes into the banking book. Why? Because the only risk that I'm faced with is the risk that the underlying obligor, which is in this case the Jordanian government, defaults and doesn't make any payments. But if I want to trade this Jordanian bond, and I want to put it in my trading book with the intention of trading and not holding it for more than 3 months. So the risks that I face are a number of risks. I face interest rate risk. I face credit spread risk. And I also face the risk that the underlying issuer defaults, and the risk that the underlying rating of the bond changes, because when the rating changes, the price changes. So you see where the difference is in perceiving the risks when you allocate an asset to the banking book and the trading book. And hence this asset will have a different capital treatment. If you put it in the banking book, it will be a credit capital treatment or credit risk-weighted asset. If you put it in the trading book, it will be a market risk-weighted asset. So you have held for trading, meaning that the instrument will be held with a trading intent. But again, there are sort of regulatory criteria how to basically allocate an asset to the trading book and the banking book. And this would be part of your market risk capital policy, which you have to develop internally. And then you have the available for sale assets. And these are basically, they're not classified as held for trading or held for maturity, but they are accounted at a mark-to-market fair value through the comprehensive income. Now, the available for sale assets are quite important. And the reason for that is that when you think about the banking book, trading book boundary, what I'm going to put in my banking book and what I'm going to put in my trading book with a trading intent, some of the assets that you hold in the banking book are basically available for sale. And this is your liquidity buffer. Yeah. So under the new boundary, what are you going to do with these assets? Are you going to keep them in the banking book, or are you going to move them to the trading book so that the risk-weighted assets are different under the credit framework and the market risk framework? So what is a trading book? Well, under the Basel FRTB regulation, all trading book positions are all positions in financial instruments and commodities in the banking book, meaning that everything that you have in the trading book and foreign exchange and commodity you have in the banking book will fall under the market risk regime. And these assets are held with the intent for trading, meaning that you intend to buy them at a low price and sell them at a later price. And there's a specific horizon of how long you can keep those assets in your trading book, for example, 3 months. So the positions held with trading intent means any of the following: any positions that are for client servicing and market making. So if you are a market maker, you buy and sell fixed income bonds, or you're a market maker, you buy and you sell clients interest rate swap or any type of swaps, a cross currency swap to hedge like FX risk. These are positions held with the intent to resell them short term, and they are intended to benefit from actual or expected fluctuations in the price. As I said, the intent to trade is you buy a bond at, let's say, 95 per 100 notional, and you sell it for 100. So that's the intent to trade, to benefit from movement in the price. The banking book, any positions that are not held in the trading book are held in the banking book, and from a regulatory perspective and risk-weighted asset and capital adequacy perspective, they have to be treated under the credit risk framework. Okay, so what are the requirements to classify books as trading books? Again, this, if you go to the regulatory text, you will find this information, but let me summarize it here. So in order to classify an asset or a book as a trading book, you have to meet certain criteria. The most important one is your trading strategy. So you have the desk, you have the traders, they trade in a particular asset class. We mentioned 5, starting from general interest rate risk to credit spread risk. And we said that the credit spread risk class is broken further into securitization, non-securitization correlation, non-securitization, non-correlation. So the trading strategy is basically how the traders are in the desk, they want to generate their revenue. Now, why is this important? It's important because the trading strategy and the measurement of market risk and the limits that you put to minimize losses are both expressions of the risk appetite statement. Okay, and the risk appetite statement is a collaborative exercise between risk management and the front office, okay, to basically come to some sort of agreement to allocate economic capital that is stipulated by the bank's management to different risk classes: market, credit, operational, and counterparty credit risk. So in order to classify books as trading books, you have to have a risk appetite statement. It has to be clear. A trading strategy. Basically, how you're going to generate trading in a particular asset class in a particular market, let's say interest rate derivatives, how you're going to generate your profit and loss. And just to let you know, the P&L, for those who doesn't know, the P&L in very high level is basically if you mark to market, let's say a single stock You buy 1 unit of a particular stock and you market to market today, and you market to market tomorrow. The difference between the two market prices, basically, if there are no cash flows, is your P&L, depending on the price, if it goes up or go down. So the trading strategy should contain what are the sources of the P&L, what are the main drivers of the P&L, what's your hedging strategy. Now, what does it mean? What are the main risk drivers associated with a particular trade? So we know, for those who trade bonds, or they know how bonds work, bonds are quite linear. So if you buy a bond, let's say you buy 1,000 units of particular bond, irrespective of what it is, the rating, the currency, the sector, you mark to market on a daily basis. You should be able to break down this change in mark to market between two end of days into the drivers of this P&L. The drivers for a linear instrument would be the delta, which is basically how the value of the bond changes if I bump up or shift the underlying curve that is used to price the cash flows up by 1 basis point. Yeah, so it should be easy to break down the P&L into the drivers of the P&L. So the drivers of the P&L, the delta, the gamma, if you have optionality, the vega. Once you get into nonlinear payoffs and things become complex, then you go into higher order sort of Greeks or sensitivities, the crosses. But we'll focus in this particular example on a particular fixed income bond. So when you generate the P&L, you should be able to map that P&L to the risk driver. What's changing that led to the movement in the mark to market that led to the P&L? A trading desk should also have an approved product list, and that's important when you're controlling risk. So, for example, if you are trading interest rate derivatives, right? So you should be able to have an approved product list saying that I would like that the desk will trade vanilla interest rate swaps, vanilla quanto swaps, where basically the payment of the coupon's currency is different than the underlying risk factor, the interest rate curve driving the floating side of the swap, for example. So you should have an approved product list to trade. And this applies to all desks, whether they're equity, commodities, fixed income, bonds, or FX. You should have business-specific market risk limits, which we will come to later. You could put limits on currencies. You could put limits on risk bucket maturities, the sensitivities, the Greeks, the delta, the vega, the gamma, and the higher crosses, your expected shortfall and VAR models, metrics, whether they are in the ones that you calibrate to normal market conditions or the ones that you calibrate to a stressed market condition, for example, given a particular stress period. And that applies to your value at risk, and the tail measure, the expected shortfall in normal and extreme stress market scenario, and your open currency position. Also, you need to provide information on the holding period. I mean, how long do you expect to hold the instrument to generate the P&L from it. There should be clear front office booking systems. Of course, in a front office trading area, you will have different booking systems to book trades, and these booking systems can be developed internally through your IT department, for example, or they can be provided by a third-party supply provider. These systems, they do booking the trade, they do the mark-to-market valuation, they compute the sensitivities, they compute the risk metrics. And they help in the data aggregation so that you can arrive at your P&L vectors, because once you mark to market, you do a full revaluation for all trades. At the end of the day, you generate your profit and loss, then you can aggregate at the desk level, across desks and across the whole trading book to compute your global risk metrics, expected shortfall, the aggregate deltas and the gammas coming from each business. The type of regulatory capital calculation, if you're gonna basically compute it based on the standardized approach, we will come to this later. I will give you a definition on what are the components of the Basel III FRTB standardized approach for computing market risk-weighted assets, or you can use the internal models. And just remember that the standardized approach would be the floor. So every bank should compute it, and the internal models if you have regulatory approval. And to get regulatory approval to use the internal models, it requires going through specific steps. It's an interaction with the regulator, and based on the feedback from the regulator, they will allow you to use a particular model to a particular desk for the whole trading book, or maybe just for particular businesses. But we'll come to these steps in the next presentation. Of course, the limits and the legal and compliance requirements to make sure that the desk is in compliance with all regulatory requirements, external and internal policies and procedures. So now let's talk about the risk measurement. How is market risk measured in banks? Because once you get the market risk measurement, then you can set limits. And as I said, the limits and the trading mandates are expressions of the risk appetite. And the risk appetite of the bank is basically something that is dictated by the bank's management. They want to dictate their commercial activities based on the approved product list that's coming from the traders. And then they allocate the economic capital to different risk classes: market, credit, counterparty, operational. And that's how much they're willing to lose over these particular risk classes. But before they do that, we need to measure the market risk exposure on in the trading book of a bank. So banks use a variety of models. In Basel 2.5, the focus really was on value at risk. And as you know, value at risk is basically if you get a distribution of anything, you have a distribution of any variable, you just cut it at certain cutoff points, whether it's the 97.5 or the 99 or the 99.9, and you can basically ask the following question: what is the maximum you can lose at that confidence level over a particular given horizon? So the way to measure market risk, basically, it can be done using the sensitivity analysis, what we call Greeks, and that's basically if you have a portfolio, or if you have an instrument, the question that you're trying to answer here is: what is the change in the mark-to-market or the mark-to-model of this asset if I shift the underlying risk factor, driving the value of this instrument up by, let's say, 1 basis point or down by 1 basis point? Yeah. So Greeks or sensitivity analysis is the shifting of the underlying drivers of the portfolio or the asset to see basically under different scenarios, normal and extreme, what's the change in the mark-to-market and how's that going to impact my P&L? The value at risk and expected shortfall, the shortcomings of the value at risk metric to compute market risk has been well documented. It doesn't capture tail events, the assumption that basically you can liquidate all positions within a period of 10 days has shown to be false, particularly during the 2008 global financial crisis. And from a technical perspective, the square root ruling, meaning that the way you compute your VAR is that you have, let's assume that you have a single equity today, a stock. It has a market price. At the end of the day, you get the market price of this equity. And you mark your position. Let's say you have 100 shares. So the product of the market price and the 100 shares would give you today's mark to market. But let's take 301 scenarios going back in history. 301 scenarios. From the 301 scenarios, we compute the return in 2 consecutive days. The choice of multiplicative return or additive return would require a quantitative impact study that based on the risk profile of the financial institution. But let's assume we just get the return. We have 301 data points, we get 300 returns, and we apply those shocks, we call them perturbation shocks, to today's market price. We do a full revaluation across the 300 scenarios. We order the P&L, we compute the P&L, which is the difference between today's mark-to-market and the scenario's mark-to-market. That should give me the P&L, whether positive or negative. I order it, I cut it, and I get at the VAR. That's the VAR. The expected shortfall basically is the average of the observations above the VAR level. And that assumes that it captures tail risks. The problem with value at risk or all these risk measures is that there is an implicit assumption, which is, I find it very important to understand. And that implicit assumption is that the conditions the causal links and the causes that caused the price to be that on a specific day, on a specific scenarios are repeating. Of course, that's a very strong assumption because we know conditions change. We know that causes are different that drive prices up or down. Therefore, it's a strong assumption, and it has to be sort of augmented with other risk metrics to account for events that happen in the tail. And we'll come to that later when we talk about the default risk charge, which is specifically targeting those events that occur above the 99 percentile of measured by the VAR model. The stressed value at risk and stressed expected shortfall metrics, these are the same as the value at risk and expected shortfall. The only difference is the calibration period. Let's say you have a portfolio of assets, and this portfolio has different exposures to FX, interest rate, and equity sort of risk factors. In order to assess the stressed value at risk and stressed expected shortfall, you need to calibrate your portfolio, okay, to a period of excessive market stress. So you need 301 data points. So let's assume you have data that is liquid, approved by the regulator to include in your value at risk and expected shortfall model. You have that goes back 10 years. So for each year, you need to compute your stress value at risk and your stressed expected shortfall. So you will have 10 computations each, right? From these 10 computations each, you need to take the maximum. And that would be your stressed value at risk and stressed expected shortfall. Now, of course, there are other methods to compute this using assumptions on the underlying distribution of returns of different assets. But this methodology is basically the sledgehammer methodology, and it is used, which is basically what we call the historical simulation value at risk. Another risk metric is the incremental risk charge and the default risk charge model. The default risk charge model is a model that computes the losses that arise on trading book positions that arise due to two risk factors. The first one is the rating migration. The rating migration of the underlying obligor. And the second risk factor is outright default of the underlying obligor. So the Basel 2.5 introduced the incremental risk charge model, and it is computed over a 1-year capital horizon at the 99.9 percentile. The incremental risk charge, which is the Basel 2.5 model, takes into account two risk factors driving losses in a trading portfolio. One is the outright default of the underlying obligor, and the other one is the rating migration of the obligor because it impacts the mark-to-market value. In Basel III FRTB, it reduced only to computing the losses that arise due to outright default. Of course, default and rating migration are not frequent event. Yeah, these are infrequent events. Therefore, the VAR model alone is not able to capture them because they happen in the tail. So the VAR model and the DRC should be sufficient to cover your expected losses and unexpected losses that arise to these infrequent events. In terms of model applicability, and this is the scope of risk factors that are basically included in your default risk charge model, you have, for example, your corporate and sovereign bond positions, your corporate floating rate notes, listed futures on sovereign bonds, total return swaps, corporate and sovereign, CDSs, and index CDSs. And as you all know, a CDS basically is a credit default swap. It's an insurance contract that insures against the default of the underlying obligor. You buy a fixed income bond or a floating rate note, and you want to basically buy insurance to protect yourself against the default of that underlying obligor. The definition of default has specific definition under ISDA terms, not only failure to pay, but there are other aspects to it. So to define when a default is triggered. The model applicability of the default risk charge basically include all these positions, but it doesn't include securitization positions and into default credit derivatives. These are capitalized under the securitization framework. And just to give you an idea of securitization, we're talking about positions where you have asset-backed securities, for example, mortgage-backed securities, where the underlying assets are mortgages. A mortgage, they collect premiums. So you can collect the premium and create a structure where you create some tranches, and each tranche has a different risk-return profile depending on the homogeneous riskiness of the underlying obligors. This particular structure could be a mortgage-backed security, it could be a CREB, could be collateralized real estate backed up transactions, or it could also be nth default credit derivatives. These are much more complex structure. Same concept. For example, you have the collateralized debt obligations and the variations on those, the squared and things like that. So the idea for these particular products is that you get a bunch of receivables, and the receivable could be car loans, could be credit card loans, could be mortgages, could be coupons you collect on bonds, corporate, a BBB rated, for example. You put them in a structure called a collateralized debt obligation structure, and basically you break down the structure into different tranches based on the risk return profile, and basically you start saying that, okay, default happens if you have n defaults within a tranche or across the whole structure. So these are not included in the default risk charge under FRTB regulation, but they are capitalized under the securitization framework. So another sort of way to measure the market risk exposure is using stress testing and scenario analysis. And stress and scenario analysis, basically, what you see here is a different scenario. You have a scenario and impacting different risk factors. So, for example, we see interest rate volatilities. Interest rate volatilities are the cap and basically floor volatility surfaces and the at-the-money swaption volatility surfaces. You need to be familiar with those, because not only these are used in calibrating certain models, but basically they are used to basically gauge the riskiness of the underlying portfolios. And these are the risk factors that are basically bumped and shifted in order to compute the mark-to-market and the P&L. So let's take, for example, the Black Monday scenario, and that happened in 1978. So basically, during that time, we have a snapshot of the market, meaning what happened to interest rates, what happened to interest rate volatilities, what happened to credit spreads, what happened to equity prices, what happened to the foreign exchange, for example. We use this data, okay, and we apply the shocks or the values to today's market value. We do a fair reevaluation of the current portfolios, and then we compute the P&L, or what we get the P&L vectors. So we can use scenario analysis to set up limits, to put limits on exposures, end-of-day exposures. And there's about, I think, there's about over 200 financial crises and banking crises that occurred since 1900 that are well documented. And we can use those scenarios, knowing what happened in the market to different risk factors. We can apply that to current market rates and risk factors and market codes, and do a repeat of those events to see what happens to portfolios if these events repeat. Now, under the fundamental review of the trading book, we have 12 minutes. Under the FRTB regulation, and let me give you, let's talk a little bit about the way that the market risk is quantified under the Basel III FRTB regulation. So under FRTB, the bank capital, the amount of capital that banks should hold in order to cover for expected and unexpected losses, is broken down into two components. They call it Tier 1 capital and Tier 2 capital. Tier 1 capital is basically shareholder equity and returned earnings, and which is reliable and liquid. And Tier 2 capital, which is basically comes in different forms. So it could be subordinated debt, it could be different types of reserves, discrete reserves, loan loss reserves, It could be hybrid instruments such as CoCo bonds, which you see that they're not as liquid as Tier 1 capital. So the capital adequacy ratio takes the ratio of the sum of Tier 1 capital and Tier 2 capital divided by the bank's risk-weighted assets. And the risk-weighted assets cover market risk, credit risk, operational risk, and counterparty credit risk. This capital adequacy ratio under Basel 2.5 was set at 8.5%. It was increased to 10.5% under Basel III. Now, in order to calculate the risk-weighted assets for market risk, banks have two options. The first one is to use something called the standardized-based approach. And the second option, if they meet the regulatory requirements, is to compute it based on the internal models approach. The standardized-based approach for computing market risk capital, it breaks down the process into three components. The first component is what the regulator calls the enhanced delta plus method. The second component is the default risk charge. And the third component is the residual risk add-on. For each component, it has to be computed per risk class. And we said we have 5 risk classes: general interest rate risk, foreign exchange, commodity, equity, and credit spread risk. And the credit spread risk, as we said before, it's broken down into further 3 components. So the enhanced delta plus method, which is the first component, relies on the sensitivities that we talked about. Again, we're talking about interest rate sensitivities, foreign exchange sensitivities, credit spread, the credit spread in bonds and CDSs. Yeah, we are talking about equity prices, spot. We're talking about derivatives that are valued based on some volatility surface or volatility cube, for example, equity derivatives or interest rate derivatives using cap, floors, and swaption volatility surfaces, or FX derivatives using the implied FX volatility surface, taking into account, for example, the risk reversals and the butterfly, which is basically to incorporate specific aspects of the behavior of volatility during market stresses or when it approaches the money level. So these are the risk factors that are basically fed into the enhanced delta plus method. And the enhanced delta plus method, it breaks down the sensitivities into 3 components. So you have the delta, which is the change in the value or the change in the value of an instrument or a portfolio for 1 basis point shift in the underlying curve. It also has the vega, which is the change in the value of a portfolio for a change of an 1% absolute shock in the underlying region of the volatility surface. So by shocking these different risk factors, we compute the delta, we compute the vega, and we compute something called the gamma. And then we basically take the difference between the gamma and the delta to compute the curvature. So the enhanced delta plus method under the FRTB regulation computes the delta, the vega, and the curvature risk class per risk factor. And then it moves to compute the default risk charge. And this is for all defaultable instruments. If you have bonds, for example, they could be sovereign bonds, they could be corporate bonds, they could be municipal and local bonds. And it looks at different ratings and it looks at the seniority of the underlying bond, equity, non-senior, equity senior, or subordinated debt. The idea is that for each movement in for a shift in the credit spread, you have to basically multiply the exposure per tenor with a regulatory risk weight to get the regulatory prescribed risk weight. And then you need to aggregate within across buckets and within the same risk class to arrive at the market risk charge for that specific component of the standardized based approach. In this case, is the default risk charge. And then you have the third component, which is the residual risk add-on. The residual risk add-on is basically a market risk capital charge that takes into account all trading book positions that have a not so simple payoff. And what I mean by a simple payoff, for example, let's take a vanilla fixed income bond. If you know the mark to market of this bond on 2 consecutive days, then it is easy to map the change in the mark to market to the drivers, which is changes in the interest rate. So you can break down the P&L into the delta, and the gamma. But there are certain products, for example, more complex products, for example, FX barrier options, or range accruals, or basket options, equity or otherwise. You need to basically look at the correlation of the underlying instrument so that you understand the payoff structure, so that it makes the payoff structure nonlinear. So the enhanced delta plus method and the default risk charge will not capture all the risks. So you need to compute it under the residual risk add-on. So it applies to all instruments that have a nonlinear payoff. And as I said, barrier options and basket options and spread options and all these sort of exotic, we call them first, second, and third generation types. So the idea is that you take the gross notional and you multiply it by a regulatory prescribed weight. Could be 1% or 0.1%. So this takes care of the standardized based approach. Now, the default risk charge applies to 3 classes of risk. We said the securitization correlation, and the securitization non-correlation. Using this particular method, you can compute the risk weight for market risk. The other method is basically if you get any sort of regulatory approval, you can apply the internal models approach, and the internal model approach relies on the expected shortfall metric. The problem with it is that it is highly computationally intensive. You need significant IT infrastructure to support these calculations. But the requirement is that you use historical simulation, you use 301 historical prices or quotes to get 300 returns, that you apply these shocks to today's market rates, you do a full revaluation of the portfolios, you look at the current mark-to-market and the mark-to-market in each scenario, you take the difference, that's your P&L. It uses 10-day risk factor perturbations using overlapping time periods. And this is important because the way that the VAR was computed under the Basel 2.5 regulation is that you would compute the one-day value at risk, and then you take that number and you multiply it by the square root of 10. And that could give you a good approximation for the 10-day VAR. But under the FRTB or Basel III FRTB, that's not allowed. So you need to look at 10-day perturbations and take overlapping time periods to create your time series, do a full revaluation of the underlying portfolios, and then compute your metrics. And it is computed at the 97.5 confidence level. The VAR was computed at the 99 confidence level, and that gives you basically the expected loss in the tail. So we take the average of the observations in the tail, and that gives you the expected shortfall. Now, what are the configurations of the expected shortfall? Well, you have basically 6 levels of aggregation. You have 5 risk classes, 1 on the whole trading book. You have 5 different liquidity horizons, and then you have reduced set and current set and complete set. So there's a lot of work to be done there, yeah? But this gives you an indication of the requirements, and we will dig deeper into this in the second presentation when we talk more about the different components of the internal models and the standardized based approach for computing market risk capital. Now, I'd like to basically move on and talk a little bit about market risk management. So in any particular financial institution, in a bank, a prudent risk management is applied, and that means that you have the 3 lines of defense. The business, the traders own the risk. Risk control, they set the limits. And the risk appetite in collaboration with the French office and approval by the management of the bank based on the way they decompose their economic capital to different risk classes. And then you have the risk governance structure, the risk appetite statement, the policy framework, and the rigorous processes and controls. And this is important because when you want to use and you want to include a particular desk in your internal model, you have to have an overall assessment of the bank's firm-wide internal risk capital model. And that means you have to have robust sort of framework in place to basically convince the regulator that you have control of the exposures that are coming from your exposure to different type of market risk factors. This gives you a good summary of the process of market risk management. So you need to basically the static data, the counterparties, the netting statements, the collateral, the trade repositories, the bonds, the CDSs, the equities, the equity indices, the different types of derivatives, the different market data, the spot rates for FX and equity, the different volatility surfaces that are used in the risk and valuation. Once you have this information in your systems in the bank, you need to basically, in actuarial work, we do economic scenario generation where we generate forward different rates. We use here risk factor evolution, then we do for evaluation of the trades, we do the aggregation, and then we slice and dice these exposures to arrive at the different risk metrics. We have about 5 minutes left. So let's talk a little bit about the actuarial skills and their role in market risk management. So actuaries they can be involved in risk quantification, business impact analysis, risk communication and collaboration. And let's just talk a little bit here. I mean, I see them basically the actuarial skill set is complementary skills and perspective. They can be involved in developing the methodologies for different internal models. They can be involved in validating those models. They can be the get-to point between the business and the regulators. Some of them, they have sort of actuaries can see across the whole business through their enterprise risk management skills to see how all these bits and pieces of different risk impact the broader risk profile. So we are experts at quantifying uncertainty, which is something that we can do very well. We have good communication skills. So to give you an example here, we can be involved in drafting the risk appetite statement. The risk appetite statement is a collaborative exercise between risk management and the business. The risk management, they set the limits, the business basically set the trading mandates, and we can draft those sort of risk appetite statements. For example, we can be involved across the 3 lines of defense, whether in trading, whether in risk management, or even audit, making sure that everything's just running smoothly. We can also add a lot of work currently in what we call assessing the operational resilience of financial institutions. And that's something where actuaries also can contribute significantly. So I think now we are at 3 o'clock. So I yield the floor back to Ian, and thank you all for watching the presentation. Ian?
Thank you very much for getting through all of that in the hour. I would just round up by confirming you'll find a point on this slide that in my experience in banking, actuaries can contribute across all areas. There's not a particular area that's obvious. You might think model building, model validation, but communications, risk appetite statements are important, judgment, not just compliance. The experience I have in banking is what Lauren says here about collaboration. In banking, particularly in investment banking and risk management, you're going to meet people with financial master's degrees, other qualifications, other skills, other experiences. And you generally work in multidisciplinary teams. And my view is that actuaries can bring complementary skills and experience to such teams. Thanks, Lawrence. Michael, do you want to round us off?
Thank you.
Yes, that's okay. Thank you. Thank you very much, Ian. So we are just about on time now. So thank you very much, Lawrence. And there's a lot of knowledge there. And for everyone who is still here, please do not forget to join us on the 5th of November for the second session, which is the second part of market risk management and measurement. So Lawrence will be back to talk to us again, and he will cover all the issues he has left out. He will be back with Ian, and let's hope you will enjoy. And wherever you are, we are holding these banking webinars so that we really show you that as actuaries, you have the skills. The toolkit is there for you to be involved in banking, and market risk is just one example. Otherwise, thank you to everyone. Thanks, Nancy. Thanks to Mid Punjab. Thank you very much for a great session. Lawrence and Ian, see you again on the 5th of November. And everyone else, keep well. We will see you again at the second session. Thank you.
Thank you all.